All right, so welcome to today's Monday morning mortgage update. We're going to be jumping right into what's happening with rates because we've had a pretty good week this last week, and we're going to see kind of what happened, where we're going, and what the future looks like. So I'm going to go ahead and share my screen right away today and jump right in here.
Well, Sean, don't also forget to mention a few things. We have our first coaching session with Aaron.
Oh, yes. Let's go ahead and Christy, announcements. I got too excited. Sorry.
I just have a few things. I just don't want you guys to miss out on this. We've had several people already join in with us, but Aaron Hodson's coaching will be starting this Wednesday at 9 a.m. So I don't want you guys to miss out. If you're on this call, I'm going to get you the link so that you can sign up. If you haven't already, I see a lot of you have already signed up. A lot of you that are on this call have already signed up, and thank you. It's going to be incredible. If you have not heard Aaron, I'm just hop on, listen, and I think that will do it because he is that good. And I think he can help you guys transition into this new market and really help you along the way. Just with everything in your business, if you're a new agent, if you're an an older agent, whatever it might be, he's going to be able to help you guys. So please hop on Wednesday at 9 o'clock.
Hey,
I'll send you the link. Yes.
I've been getting his notifications for Tuesday at 9 for
Okay,
coaching
we have
calls.
a national call.
Oh, that's what that is.
And once you sign up with us, you get access to that national call. But our team, specifically the Wolin Mortgage team's calls, will be once a month. And our call, just with our agents, Arizona, that whole thing will be this Tuesday.
Oh,
So
okay.
make sure you're
Or Wednesday.
calls too. Yes, I'm sorry, Wednesday. Make sure you jump in on those Tuesday calls, but also join us Wednesday at 9, just because it's going to be more of kind of what you guys are going through as a whole, and kind of like, just wrap our arms around more of Arizona and not nationally. So you want to hop on both if you can.
Okay, thank you.
Yes, thanks, Valerie.
Absolutely. Absolutely. So thank you, Christy, for that. So yeah, some good news with the interest rates this last week and a half. I'm going to kind of go over what happened. I'm going to go right to the charts to kind of show you where we're at, and then kind of go over in detail as to what happened, why rates are better, and kind of where they're going to be. So I'm actually pretty excited. It's one of those times where sorry, I'm letting a few people back in here, where I think rates are starting to show a trend in the right direction. So without further ado, I'm just going to jump right in and share here. So this is the candlestick chart for the Fannie Mae 30-year bond on the 6% coupon. So
I don't think that's it, Sean.
No? Am I the wrong screen here?
I'm seeing compare. Yeah, that was wrong screen.
Share screen. We're on the right screen?
We are. Thanks.
All right, there you go. All right. So what we saw, look at this wonderful green pattern here. We saw this trajectory up here, and you notice on this point right here, right where I'm lining, see this line, this Fibonacci level? Last Thursday, we saw a huge run up, and the bond market touched on this Fibonacci level, but then it retreated and it closed way down here. So we went up all the way up to here, and then we retreated. So the bond market improved, and this was a really, really good day. Employment numbers came out, inflation numbers are lower, everything was pointing in the right direction. And we saw this really big run. And then if you notice where this green box on this candlestick ended, this is where we ended the day. But we went all the way up here. So you might ask, well, what happened? I mean, we were at 101.2 and we ended the day at 100.92. So we lost 28 basis points for some reason. Like, how did that happen? Well, what happened is we had the economic information came out with the jobs and the inflation numbers and everything. This is why it went way up. But then we had what I've been telling you as the tug of war between rates going up and rates going down is the fiscal spending. So this infrastructure bill that was passed, it's trillions and trillions of dollars. The government doesn't have that money. So what do they have to do? They have to sell bonds to raise that money. Now, if you oversaturate the bond market, it's going to make them worth less. Nobody's going to want them. Well, there's these bond auctions that happen, and the government has to raise the money. The only way they do that is through auctioning off these bonds, basically going to you and me and say, I don't have any money. What if I was to give you 5.2% on your money for the next 10 years or 30 years, however long that duration is? Well, one of those bond auctions happened midday on Thursday, and it was a horrible result. Nobody wanted them. So with bond auctions, what happens is they come out at a certain level and they say, okay, guys, we're auctioning off, starting bid on this is going to be a yield of 4.875. And if nobody wants it, they just keep raising the yields on that until somebody buys these bonds, because they have to raise the money. Well, that's inflationary. So what we saw is really good news with the economy, with inflation coming down, with jobs numbers being weaker. And then boom, tug of war happened. We pulled all the way back based on this terrible bond auction. Well, the Friday, we kind of regained some ground on some more good economic news. We've had a lot of comments with Powell talking about potentially having a rate cut come September is the first rate cut, which would be great. We don't think the rate cut's going to happen in this July, but come September, the odds are very, very high for a rate cut. We're seeing a weaker economy. We're seeing the buyers or the consumers being stressed out on debt. We're seeing higher unemployment numbers. We're seeing lower inflation, all good things to show rates are on the right trend. Now, I talked about this all year, that tug of war between what the markets are doing and what the government is doing with these bond auctions. So if we continue to see poor bond auction results, because keep in mind, we still have a massive amount of bonds to sell out in the markets to raise the money for this infrastructure and the CHIP Act. So that money that comes from somewhere, and that's where it comes from. So we're going to see this tug of war. It looks like we have strong momentum, though, which is a really good sign. We have really good momentum. But here we are. We bounced off against this Fibonacci level, and we came down. And then we're right here today, kind of stuck beneath this. So if you notice, if we go back in time, and forgive me for getting nerdy, if you go back in time, the last time we were above this level, and we saw rates improve better than where they're at today, it tried to go there in March of this year. And the last time it was above this level was February of this year. So 6 months, rates are the best they've been in 6 months. So really, really good, exciting news. Rates have come down. We're now in the sixes comfortably. Unless you have poor credit, then it's going to be higher. But we are in a really, really good position. So I'm going to kind of show you where rates are hanging out right now. On Mortgage News Daily, if you go there, that's a great site. You can look at. It's a great third-party site to kind of show you where we're at. So we're just below 7% now, average across the nation for interest rates. Now, keep in mind, they use one method of getting a rate. Single family detached, 30% down, primary residence, 780 credit score. That's what this is modeled on. So if you are less than that, or if you don't have a good credit, or you're putting less down, your rate could be higher, but it's a good trend. So we're excited to see this. I think we're in a good spot. Come September, we're going to be in a position where I think rates are going to continue to pull back, depending upon these bond auctions, because these bond auctions can be that tug of war that's pulling against what we really want to see in mortgage rates. So it's going to be interesting to see how this trend continues. Will we stay below this? Will it come back down? Because we bounce off this again and come back down, there's a lot of movement we could lose. But if we can pierce through this, we'll see what happens this coming week. If we can pierce through this, we're going to be in good shape. So let's look to see kind of what's going to be happening for the economic calendar this week. The New York Empire, the manufacturing index came in today. So you look at that, it was, hasn't come out yet. So once that comes out, we'll see how the manufacturing index comes in. Import price index, we have retail sales. Retail sales should be weak. That should be good for us. We're going to see housing starts and building permits. And guys, here's the ugly one. We've got a 20-year bond auction on Wednesday. That could make rates kind of push negative and go in the wrong direction. So we're going to really keep an eye on this. The beige book, kind of the notes of the feds, we're going to see what that shows on Wednesday as well. Then on 18, we have jobs week. We have the jobs numbers, initial jobless claims and continuing claims. This should point in the direction of higher unemployment slightly, not massively, but we're seeing the trend in a really good position here. Remember, I keep talking about this. Bad economic news, higher unemployment is going to be really good for mortgage rates. So if the market's really hot and we have really low unemployment and good consumer spending, that leads to inflation. The feds are trying to pull that inflation down. So what they're trying to do is get the unemployment numbers higher and inflation lower. That'll bring rates down, and that's what we're seeing right now. Finally, we're seeing them being congruent together. We didn't think we'd see much of a move with inflation, but we are slightly in the right direction. But we're seeing the unemployment numbers fall in exactly what we need for the feds to start cutting rates, and that's most likely the high percentage of that happening in September. So super excited for that. If you do have buyers that are waiting, remember you can always refinance later, and I've got the cost of waiting scenario here. We can put together some really good scenarios. If we do like, I'll just do a quick one for you right here. We've got a $650 purchase price, taxes and 85254. Let's just say the 3,200. Put homeowners insurance in here. This is the cost of waiting calculator. Forecast what the rates are going to be in the future for appreciation. And this will put a nice little report together for you on, let's just call it Monday. So if you have anyone that says they want to wait, we can do 30-year fixed in here. We can put the down payment. They have 10% down, 5% down. I'm just doing this real quick. Rate currently is 6.875, 0 points. And monthly insurance, that's going to be about 150. And then we hit next. This cost of waiting, the benefits of buying now, they'll benefit from waiting a year. They'll benefit 25,752. And this is expecting lower interest rates in the future. It's still better to buy now. So these cost of waiting reports, I can put them together for you. They're really nice. We can review the report. We can print this up and make it so it's a nice PDF for you, so you can share. It's really kind of cool. So you can share here. We can record a video with it. You can download it. You can send this out to your customers and show what waiting a year would look like compared to buying now. And it really is great. So notice it has a year from now rates in the 5s, because that's what they're expected. It takes that into consideration. Still better to buy right now. So really excited for what this week's going to bring. Right now, we are down about 5 basis points for the day on the Fannie Mae 30-year fixed bond. And hopefully we'll see a little bit better interest rates as we go through the week. So any questions on what's happening with mortgage rates currently? Have you guys seen anything out there that you're questioning? There's a lot of things that have been brought up, including special websites and partnerships with lenders to give back commissions towards closing costs. A lot of these items are going to be popping up as this August 1st deadline for advertising on the MLS to commissions is coming through. So any questions on, sorry, I'm just admitting some of it. Any questions on what the markets are doing? Anyone have any weird scenarios that you have that you want me to have a look at? I'm going to look at the chat right here. I have a friend with a fairly high interest rate. How much should the interest rate drop for her to be good to refinance? There's actually not a good percentage. If it's free and you're saving $100 a month, it makes sense. What doesn't make sense when you refinance is, let's just say you've been in the loan for 3 years and you go to refinance and the lender puts you in another 30-year fix. So they add 3 additional years. Well, you've already paid 3 years worth of interest. You need to do a 27-year term on the refinance. not restart the clock with a 30-year. So I urge anyone that's thinking about refinance to talk to me about the strategy on that, because if it doesn't cost anything, meaning if the rate's low enough where we can give a lender credit to pay for everything, so it's completely free, there's nothing rolled into the loan, and it saves you $100 or more, it makes sense. Especially if you're not restarting the clock and you're making it so that whatever's left on that current mortgage, that's the term we do on the new mortgage. So if you've been in it 5 years, we're not going to do a 30-year. We're going to do a new 25-year to match the term, the timeline you have still on that refinance. So refinances are going to be a big deal moving into the next year. So if you have some people that are looking for savings on their, or if you know people that have purchased a home with rates in the 7s or 8s, it'd be a good conversation as the real estate manager to reach out and say, I noticed that when we helped you sell your or buy your home, you were in the 7s or 8s. You may want to talk about potentially refinancing. I mean, I'm going to be doing that anyhow, but if I'm not involved with that transaction, it's just a good touch point to reach out to your customers. I have heard her talk about her best strategy. I have her talk to, oh, perfect. Thanks, Carla. What would be a good candidate for refinance? Yep, same question. So anytime you can save money and it's free and it doesn't lengthen the term of your mortgage, it makes sense to look at it. Now with rates going to be dropping in the near future, can you refinance over and over? Absolutely. If you refinance today, if you had a rate at 8 and now you're refinancing 6.875 and rates drop again in a year to 5.875, again, if you're not adding and increasing your loan balance by refinancing, if it's free and you're saving money, it makes sense as long as you're not adding years to your loan. So that's the biggest, I think, mistake people make when refinancing is they could have had the loan for 15 years. I doubt they've had it because mortgage rates were super low and everyone was refinancing a couple of years back, but where they redo it on a 30-year, it doesn't make sense. Now, one other thing I am seeing, if you have buyers that are in trouble, if they've bought a home 2 years ago, they maxed out all their credit cards and they're thinking about refinancing, even though their rate may be better than what they are now, sometimes it makes sense to refinance. And here's why. If you have credit cards at 23, 25%, student loans that are weighing you down, if you're in a position where you can't afford life and you may be put in a position where you are forced to sell your home and become a renter just to catch up, because they probably have equity, a cash out refinance may be a better trick to keep them as an owner of a property. I've seen a lot of circumstances where people are selling their homes, taking their equity, paying off all their debt, renting for a while to get back in. A cash out refinance may be a much better tool to do that without having to no longer become a homeowner. So as advisors, we may want to talk to our customers about that if they are in that pickle, so to speak, in regards to a lot of debt, because there are quite a few people right now that are strapped because they lived on credit cards thinking that rates were going to come down, and they had the same spending habits of what they did during the COVID days where money was plentiful, stimulus checks were just flowing. It's the opposite right now. People are using credit cards to live. So if you do have those strategies, let me know. But that's a quick input into what's happening in real estate this week on the mortgage side. So super excited that rates have come down. Rates are in the 6s for those that came on a little bit late. A really good week last week. It would have been better if we didn't have that terrible bond auction that happened where it was horrible results. And we do have another bond auction happening this week. So keep your fingers crossed that bond auction goes well. And we'll go from there. So thank you guys so much for logging in this morning. If you have any further questions, I'm always here to help. You can also go to my website, Wolin Mortgage Team, to find all of our tools, including FICOBoost.com to help people that have lower credit, and all the other tools that we have to provide for you. So any questions? Any unique scenarios? Those of you that came on late, any questions on what's happening in the markets that I can maybe help you with as well? All right. Well, it's Monday. It's going to be a hot one this week. And it's summer and we all know the heat comes, but we're all shocked when it hits our skin. But enjoy this week, guys. I'm always here for you. And I just hope to be part of the conversation. If you do have buyers that are looking to get pre-approved, I would love to be part of that conversation. So thank you so much for everything, guys. I'll stay on a little bit longer for any TL questions we have here. And you guys have a great day and we'll talk to you soon.
Sean, I just have a comment.
Sure.
I've owned a home since I was 20 years old, and I've always had lenders reach back out to refinance. And I just did the math of what my payment was times an extra 2 or 3 or 4 years. And I'm like, this doesn't make any sense. And they're shocked, like, oh, well, that's what it is. So thank you for realizing, like, it makes more sense. You can only compare apples to apples if you keep the same end date on that term.
Yeah.
So
Yeah.
I appreciate you looking at it that way, because every time I've pushed back, they're like shocked that I would push back or that I
Yeah,
can do
and
it.
they never tell you that you can get any term you want. They never bring that up because they're just people in call centers making phone calls, trying to sell a script. But yeah, no, I mean, people on here, did you know you can do a 23-year term? Did you know you could do a 17-year term? Most people didn't know you could do that. So thank you for pointing that out, and thank you for recognizing that, because that's where our industry goes wrong. And it's a big problem with our industry.
And it's those little things that you have that, I mean, make you a great lender.
Well,
So,
thank you, Melanie. I appreciate that. I'm always looking out for the buyer because, well, we try to do what's best for the buyer in all circumstances. And I will always go to the ends of the earth for them and make sure they are well educated. So that's why we do this, right? So yeah, any other questions? I'll hang on for a little moment. Thank you, Melanie, for the kind words. And you guys have a wonderful Monday.
Thank you, Sean.
You're very welcome.